Okay, it's the bad news is the coffee break is over, and it's been a long day. The good news is we have an excellent last panel for our conference today. So I would like to introduce our speakers. We will have Hyeyoon Jung from the Federal Reserve starting, presenting her work with her co-authors on measuring the climate risk exposure of insurers. And this talk will be followed by the talk of Luca Zanin, who will be presenting his paper on climate stress testing for mortgage default probability. And our last speaker on the panel is Mario Bellia, and he will be talking about flood protection gap, evidence for public finances, and insurance premiums. And finally, after these three presentations, we will have a discussant, Peter Windsor. And unfortunately, our discussant, you look around, where's our discussant? Our discussant is not here. Our discussant will be speaking, was not able to come, so we'll be speaking online. So don't worry, there will be a discussant. Okay, so without further ado, Hyeyoon, why don't you begin?
Okay, great. Thank you so much for having me. I'm very excited to present my paper, Measuring Insurers' Climate Risk Exposure. And this is joint work with Rob, Shan, and Xuran at NYU Stern, and I'm from the New York Fed, so the usual disclaimer applies. So understanding the impact of climate change on financial stability is a very important question for researchers, financial institutions, and regulators alike. And insurance sector is one of the key financial sectors, and they can be exposed to climate-related risk through their operations, as well as their $12 trillion financial asset holdings. For instance, physical risk can affect insurance companies with higher than expected claim payouts, and transition risk can affect insurers' investments, for instance, in fossil fuel industry. And one of the credit rating agencies, AM Best, views that the insurance industry is not well prepared for the challenges coming from climate change. So despite of this importance, it's very challenging to measure insurance companies' exposure to climate risk. And before jumping into the model, let me discuss some of the few challenges and explain how we try to address them. So first of all, analysis based on the past climate events may not effectively capture the changes in the perception of risk. And this is because market expectations can change without a direct experience of climate change events. And also market prices today, asset prices today can reflect the changes in the future climate risk, even if the damages themselves materialize in decades. So to this end, we use a market-based approach, allowing us to fully incorporate the changes in market expectations. And second, climate risk itself changes over time, and how firms, financial institutions, and market participants respond to the perceived risk also changes over time. So we estimate a dynamic model which allows volatilities and correlations to be time varying. And lastly, data gaps and timeliness have been pointed out as one of the key challenges, and our methodology only requires publicly available information. And we estimate our model on a daily basis, so we hope that our measure could be a useful and timely monitor. And by using market-based approach, we can construct plausible and sufficiently severe scenarios, so that's also benefit. So in this paper, we use a market-based approach to assess the resilience of financial institutions, specifically insurance companies, to climate risk. And the approach involves 3 steps. The first step is to construct physical climate risk factors that go down when the perceived climate risk goes up. And once we construct this factor, then in the second step, we estimate insurance companies' climate beta. And the climate beta captures insurance companies' stock return sensitivity to the factor that we constructed from the first step. And once we have the beta estimates for each insurance company, then we can compute systemic climate risk, which we are calling C risk. And the C risk is the expected capital shortfall of insurance in a climate stress scenario. We use this approach to study climate-related risk exposure of large insurance companies. And here are some of the key findings. First, on the property and casualty P&C insurer side, we find that the risk is concentrated on the smaller insurance companies. We find that in a physical climate stress scenario, we find that the top 10 largest P&C insurers were actually having excess capital reserves in some cases, but smaller insurers seem to face greater physical risk. And on the life insurer side, we find that life insurers' transition climate beta went up sharply in 2019-2020 when the fossil fuel prices collapsed and the attention to the climate change rose sharply. In terms of the magnitude, the aggregate marginal transition C risk of life insurers went up over $70 billion, and this is about 13% of market cap. This is somewhat lower than the bank side, but it doesn't seem negligible. And in validation exercises, we find that P&C insurers' physical climate beta reflect their operational exposure. So P&C insurers having a lot of operations in risky regions seem to have higher physical climate beta. And on the life insurer side, we find that if the life insurers are holding a lot of brown investment, then they tend to have higher transition climate beta, which add validity to our measure. So let's start from the physical climate risk factors. Let me explain how we constructed the factor. We use a portfolio of P&C insurers' stock returns, and they are designed to fall as the physical risk goes up. So how did we do this? We merge insurers' direct premiums earned from different regions, and we merge this data with property damage due to natural disasters from shelters. We merge these two at the state year level. And then for each year, we compute each insurer's risk. And the risk is computed as the weighted average of the riskiness of different states, where the weight is exposure to the respective state. And we scale that by market equity to account for the size effect. And this risk is going to be the weight of the portfolio. So this is examples of how it works. So on the left-hand side, what you're seeing is the physical risk factor around Hurricane Harvey. And this is one of the largest, most damaging hurricanes in the United States. And you can see that before the day one, it was pretty much zero. But then we see that there was significant decline in the next 10 days or so. On the right-hand side, what you're seeing is similar, but on the Hurricane Sandy, and you can see that the physical risk factor falls significantly. These are just two examples, and we used all large natural disasters in the United States, and we regressed the physical risk factor on the shock, which is a dummy variable, which takes value of 1 if it was the day 1 of the natural disaster. And what you're seeing, and we control for the market, and what you're seeing is the cumulative response over the next 20 days. And you can see that similar to these plots, you can see that the factor falls over the next 20 days. And we were quite surprised to see that the responses are not immediate. So we followed New York Times articles to understand what was happening. And we made two observations. First of all, we find that news articles respond to natural disasters with a few days of delay. So you can see that only around day 12, the average number of New York Times articles covering natural disasters go up. And also in terms of the news content, we find that natural disasters impacts are often not immediately clear. So what you see on this graph is the headline of the articles, and you can see that on the day one, the headline was that a blast of rain but little damage as hurricane hit South Florida. So this was Hurricane Katrina, and that was one of the most damaging ones, but it's clear that the impact was not so clear on the day one. And in only after 12 days or so, we can see that Katrina and the gas pump and some discussion of relief comes up. And the day 12 happens to be the date that the coefficient starts to be statistically significant. So with this constructed factor, then we estimate P&C insurers' physical risk exposure. So we regress P&C insurers' stock return on the physical climate factor that we just constructed and the market factor. And we're calling the loading on the PCF, the physical climate factor, physical climate beta. And you can see that they move around, which suggests that it's important to estimate this dynamically. You can see that there was a sharp increase during global financial crisis. And this is because during the global financial crisis, they were highly levered. And in fact, 2008 was one of the bad years in terms of the hurricane damages. So it seems that some compounding effect is going on. And we don't see any secular trend, but in the very last period, that's 2021, and you can see that there's some interesting divergence going on. And I'm going to explain these variations in beta with what each insurer is holding in terms of their climate policy, the insurance policies. So let's imagine that we have this P&C insurer's balance sheet, and their policy portfolio is going to be on their liability side. And some of them, the policies were made to risky states, and some of them are going to be made to safer state. To characterize the riskiness of this portfolio, we first needed to characterize each region's riskiness to the climate natural disasters. So to do that, we use municipal bond returns. So for each county, we regress the municipal bond return on the same physical climate risk factor and the market factor. And we obtain each county's climate beta. And then we aggregate that to the state level by taking the 99th percentile. And because we observe the composition of the policy portfolio in this chart, we can compute the policy portfolio beta, which is the weighted average of the betas, and the weight is going to be the exposure to the two different states. So just to give you a very simple example, let's say that this insurance company is holding half of their policy portfolio in risky state and half in safer state. And if the risky state's beta is 1 and if the safe state's beta is 0, then we're going to have portfolio beta of 0.5 in this very simple case. And we compare this policy portfolio beta with these ones that use only the market prices. And this is the comparison on the y-axis. What you're seeing is coming from the market-based approach, regressing the insurer's stock returns on the climate factor. And on the x-axis, what you're seeing is coming from this calculation, which reflects their P&C insurer's policy portfolio. And you can see that they are quite well aligned. They are positively correlated. And when we did the regression with P&C insurers' characteristics, we find that they are positively and significantly related. So this all suggests that the P&C insurers' physical climate beta reflects their policy portfolio composition. And once we obtain the betas, then we can calculate the C risk, which is the expected capital shortfall in a climate stress. And this is a function of D, which is book value of debt. W is the market cap of the insurance company. And LRMES is the expected equity loss conditional on climate stress. And K is the prudential level of equity to assets, and we set it as 8%. And we calibrate the climate stress level to 20%. And this is because negative 20% is the 1 percentile of the 6-month return on the physical climate factor. So you can consider this as tail scenario. And these are top 10 largest P&C insurance companies' physical C risk. And you can see that they are mostly negative, especially in the recent time. And this suggests that the largest insurance companies actually have excess capital reserves in climate stress scenario. I don't have it on the slide today, but in the paper, we show that the C risks are higher for the smaller insurance companies. So that has been P&C insurers' physical risk exposure. And now let's think about life insurers' transition risk exposure. We follow very similar steps, so I'm going to go very fast. So we use transition climate risk factors from my previous paper with similar co-authors. And there we propose multiple factors. And these are just 2 examples. The brown minus green factor, we show that after Paris Agreement, it falls. And after Trump election, the brown stocks relatively perform better than the green stocks. So this is just indicating that the risk factor works as intended. And we obtain the transition climate beta by regressing the life insurance stock return on the physical transition climate factor. And you can see that there was sharp increase in 2020 when the fossil fuel prices collapsed and also the attention to climate change went up. And we do a very similar exercise, but now this is going to be life insurers investment side, so that's asset. And life insurers hold $12 trillion corporate bond portfolio. And to characterize each industry, we obtain the transition climate beta for each industry. And again, we observe the composition of their corporate bond portfolio. So we could obtain this portfolio beta. And again, we show that life insurers transition climate beta reflects what life insurers are holding on their asset side. So this is confirming the same thing, but in regression. And the transition C risks are positive for some insurance companies, but it doesn't appear to be a threat to financial stability. And in the paper, we show how to account for tail dependence. So the question is, does the physical risk tend to commove with market risk in the tail? And we find some evidence supporting that, but I'm not going to get into the detail. So to conclude, in this paper, we measure climate risk exposure of life and P&C insurance companies using a market-based approach. And we find that on the physical, the P&C insurance side, we find that the risk is concentrated on the smaller firms. And on the transition side, we find that life insurers transition climate beta went up sharply during 2019 and 2020. And in validation exercises, we show that physical climate beta reflects P&C insurers policy portfolio composition, and market-based transition climate beta reflects life insurers bond portfolio composition. So that's what I have prepared, and I look forward to comments. Thank you.
Thank you, Hyeyoon. I mean, it's rather surprising to me that it's the life insurers that have high risk and not the property and P&C insurers. That I would like to hear more about that. Anyway,
Sure.
Our second speaker is Luca Zanin, who will be telling us about mortgage default.
So good afternoon, everyone. So I present a paper on climate stress testing for mortgage default probability. This paper was written jointly to Raffaella Calabrese, University of Edinburgh, and Connor Thorburn of Prometeia. So extreme weather events such as tropical cyclone, flood, heavy rain occur more frequently and intensely in the United States than the past due to global warming. And damages from these extreme events represent a concern for policymakers, central bank, the regulatory authority, and practitioners in general, because they may affect the productivity and asset value and then the financial system. Stress testing exercises are an important tool for financial institutions to evaluate their portfolio vulnerability to adverse scenario, especially when these events are outside the range of the historical observation. In particular, a typical stress testing is when considering adverse macroeconomic scenario. But in recent years, there is an increase in interest in climate stress testing, which include the evaluation of the resilience of the portfolio to transition and physical risk. Here we focus on physical risk, and in particular, we apply our framework to a climate stress testing to a mortgage portfolio. So we focus on a mortgage because real estate property used to secure mortgage can be damaged from extreme events such as tropical cyclone, and then affect the ability of borrower to repay their loan. When look at the literature or exercise from practitioners, we note a lack of the common framework in conducting climate stress testing for mortgages. In particular, we can cite the work of Jung, who he stressed the PD by imposing an exogenous shock on loan-to-value ratio, but assuming a predetermined and hypothetical extreme weather events. In other words, we do not consider to stress the loan-to-value ratio by considering a science-based climate model to define extreme events scenarios. Another case study is the recent pilot climate stress test for the 6th largest US bank under the guideline of the Federal Reserve Board. One of the goals of this pilot stress test was to evaluate the impact of extreme weather events on residential real estate asset and then on the probability of default. And in particular, among the guidelines, the Federal Reserve Board recommends banks of including in the scenarios tropical cyclone events with return period 1 in 100 years and 1 in 2000 years in Northwest US. One limitation of this pilot stress test is that no larger return period events are considered in this exercise, and not uniform scenarios are considered. So this makes it difficult to compare results between banks in terms of default or impact on the real estate. So what we propose is to overcome some of these limitations by proposing methodology for assessing change in the default probability of mortgage affected by tropical cyclone events. And in this particular case, we consider events that will return period up to 1,000 years. Moreover, we are interested in other two research questions, in particular to evaluate the heterogeneity of the exposure to tropical cyclone and then the relative impact in terms of the default risk, and then the role of the insurance coverage in mitigating the effect of physical risk on mortgage default. For our empirical analysis, we consider portfolio mortgages provided by Freddie Mac in Louisiana. Louisiana is an interesting case study for our framework because it was affected by devastating hurricane the last decade. For this reason, a good case study. Now I presented our model and workflow of the climate stress testing framework. So we have a first part, we have data collection of mortgage with long month performance, information on the flood risk index, flood insurance, the map of historical tropical cyclone events, where we have information on the wind speed. And then on this information, we calculate the damage index using a specific damage function for a tropical cyclone. Then we move on the estimation of the credit scoring model using a survival approach to estimate not only the PD, but also when occur the events or the probability of default over the age life or the life of the mortgage. And in this model, we include information on the weather events and the flood insurance coverage. Then we move on the predictive accuracy evaluation, considering both an exercise of out of time and out of sample. Then we define the scenario tropical cyclone, the wind speed by return period, and on this information we calculate the damage index, which is a measure at proxy the property damage fraction in the zone. This information is used to calculate the damage adjusted loan to value ratio, and then we move on the last step of stressed PD by assuming to including or excluding the current insurance, flood insurance coverage. Now we move on the data collection. We consider for our empirical analysis the Freddie Mac single family low level data with a granular resolution at the 3-digit zip code level. The map of the historical tropical cyclone is the source national oceanic and atmospheric administration. The flood risk score is a source first street foundation, and then the insurance information is retrieved by the National Flood Insurance Program. We also consider some macroeconomic variables, in particular the unemployment rate is retrieved by the Bureau of Labor Statistics, and then the house price index at the 3-digit zip code level is used to calculate the dynamic loan to value ratio. Then we move on the estimation of the model. We first define our target variable, in particular, so this is a binary variable where it is equal to 1, then when the borrower is 90 plus day delinquency. And in the model specification, we include another function defined by the loan age, some static time varying variable, which include the FICO score, loan to value ratio, the interest rate compared to a market benchmark, the debit to income ratio, and then other characteristics of the asset. We include the unemployment rate, and then whether the insurance variable, such as the percentage of the insurance coverage in each area, the damage index, and the flood risk. And we estimate the survival model using the approach of Bellotti and Crook. Moving on the result of our estimate, we can see in particular focusing on the weather and insurance variable, we can see that the insurance coverage has a negative statistically significant impact on the PD, and the damage index and the flood risk a positive and statistically significant impact on the PD. And this is coherent with our expectation. We then move on the next step of the predictive accuracy evaluation on our model. In particular, we consider an exercise of out of time, look at 1 year ahead with respect to the data available. And then also an auto-sample exercise considering the 5-fold auto-sample cross-validation. We compare our survival model, assuming to exclude or including climate-related variable. And then we compare our model with some other benchmark model, such as binomial model using logit or probability link function. The main result from this table is that our proposed survival model, including climate-related variable, outperformed the other model specification, both by considering the exercise in out of time and in out of sample. We then move on the design of tropical cyclone wind speed scenario. For the purpose, we consider the synthetic tropical cyclone generation model that allows to estimate the wind speed at a different level of spatial granularity. Here we consider the 5-digit zip code level and for different return period. In this case, for instance, from an event with return period 1 in 10 years up to a return period 1 in 1,000 years. This is useful to have a comprehensive overview of different events at 3 different return periods. An interesting feature of Storm is that it incorporates a great number of impact events compared to alternative solutions, such as the climate adaptation model or the Columbia hazard model. And this is an interesting feature for our stress testing exercise. What we can see from this map is that the coastal zone have emerged as the area most affected by the most impactful by the events with higher wind speed, and then the most impactful in terms of damage. Then from this information at 5-digit zip code level, we apply the damage function from tropical cyclone, and we estimate the damage index. We then aggregate the information from 5-digit zip code level to 3-digit zip code level by considering the number of property that are present in each 5-digit zip code. This is to have the same granularity as the Freddie Mac low level data that are the 3-digit zip code level. With the information on the damage index, we calculate the climate adjusted loan to value ratio using a simplified approach in this case, where we have the numerator, the mortgage ending balance of loan at time t, and that the denominator, the value of a property at time t minus the potential damage for a specific return period. And the value of the property is calculated as the value of the property at the origination of the mortgage, and evaluated using the house price index at the 3-digit zip code level. And the potential damage is calculated as the value of the property multiplied by the damage index for a specific return period. Then we move on the stressed mortgage PD. So in the box in the left, we can see the exercise assuming that an event with a specific return period affects all the Louisiana. And in particular, we consider the different return period to have a comprehensive overview of the impact. In the upper table, we assume to have the current percentage of insurance coverage on flood risk. And we can see that larger is a return period of the event, and greater is the probability of default in Louisiana. So, but what it is more interesting is that if we assume to exclude the current level of insurance coverage on flood risk, this probability of default increases in a significantly way. Now, this is a view for the entire Louisiana, but if we look in a view by the 3-digit zip code level, so in the first plot we have the stress PD, in the left assuming to including the insurance coverage, and in the right assuming to remove the insurance coverage. And we can see that in the coastal zone that are also the zone with higher level of coverage in terms of the higher flood insurance coverage, that are also the area with the higher flood risk score. If we remove the flood insurance coverage in this area, we have an high increase in the probability of default. So this highlight the importance of the flood insurance coverage in mitigating the probability of default. And this is the particular case of the event with a return period of 1 in 1,000 years. So a return period very, very important in terms of the wind speed. Now we move on the conclusion. So we found that the damage from tropical cyclone with large return period significantly increased the default probability, and in particular that the effect of tropical cyclone on the default risk of mortgage loan are spatially heterogeneous, and this is an important result for Banca because it is important to consider scenario tropical cyclone location specific and not predetermined scenarios without a specific reference to each location. And another important result is that flood insurance play a relevant role in mitigating default risk in high risk flooding location. What implication for with a result for different stakeholders. So for financial institution, result from climate stress testing, as in this case, can help to identify mortgage loans that are most vulnerable to extreme climate events, and in particular include this result in their internal prudential risk management framework. Moreover, lender can inform borrower of the risk in the zone where we have located the property, and then suggest, if required, the purchase of insurance to mitigate losses from catastrophic events. And then also policymaker can consider result from climate stress testing to better allocate public funds in a more effective way to protect on working, living in high-risk areas. Thank you very much.
I guess just reacting to your presentation, one of the issues is what happens when private insurers pull back. That invites government, some form of government insurance, and then you always worry at what price is it offered? Is it really, you know, is it really reflecting the expected damages? But anyway, maybe we'll come back to that later. But I couldn't resist when I saw one of your figures with all the projections of the hurricanes over the Atlantic. What is it going to be like this summer when people say with El Nino it's going to be worse than ever? So it'd be interesting to see how your model predicts these damages this summer. Anyway, our last speaker is Mario Bellia. And he is going to talk about flood protection gap, evidence from public finances and insurance premiums. I guess continuing on.
Yes, on the very same topic, I would say. So thank you very much. First of all, I mean, I need to put a disclaimer because I mean, the compliance officers kindly asked me to put this on writing and also to repeat that this working paper has been finalized in last year, basically, when I was at the JRC. Now I'm no longer at the JRC, but I'm still in the commission. So all the views in this regards are mine. So I'm in my personal capacities and does not necessarily reflect the official opinion of the European Commission. So first of all, I just want to stress that this work has been started basically last year, the beginning of 2023, that's been triggered by a discussion that we have with the ECB and the ESRB joint group, where we contribute as a JRC on a report on the impact of climate change of the EU financial system. So after a long discussion with basically there are all the let's say the ESRB, the ECB, and all the European system of central bank. This was this was a topic that was super interesting. So we started digging into the data. And I mean, the research question is kind of, I would say, simple. So we want to estimate what is the potential increase in the insurance premiums if we increase the insurance penetration for river and coastal flood up to 50% or 75%. For the member state, of course, for the countries, the European countries that are below these values. So the question is kind of simple, but unfortunately, this is not a trivial stuff to come up with. So on top of this, we also try to model what might be the potential reduction in the public finance losses from this increase in the insurance penetration rate at the European level, considering also a pretty bad worst case scenario when the insurance is, of course, not kind of able to repay the, let's say, the damages because there are also insurance failure in the insurance sector. So, of course, the first issue that we got was like which data we use. So there were like several opportunities. Either we use market data, as the colleague of the Federal Reserve did, for the European market, but yeah, I mean, this was not our first idea. The second idea was to use, of course, to have very granular data on the portfolio of the insurance companies, so knows where there are the properties, where they are kind of having all their policies and so on. But this is unfortunately not available. I mean, at least in the European Union, for the banking sector, there is, I would say, much more much more detailed framework on all the position and so on. There are databases and so on, but for the insurance sector, we are still, let's say, a little bit behind on the data collection. So the only things that we can do is that to use aggregate data, still from EIOPA, which is the agency in the European Union, which is dealing with the insurance companies. So since I was at the JRC, the Joint Research Center, we have a very nice unit, which is the Risk Data Hub unit, which is doing very nice things. So they have a lot of data. They collect a huge amount of data on disaster losses, both from the historical nature at the local, region, and national levels. So with this kind of data, they geo-reference all the exposure data for a lot of assets. So they know, I mean, they kind of put a value for buildings, population, critical service like infrastructure, roads, or electrical connection, and so on. And they put a vulnerability indicator on this. So this was our starting point. So we have this very nice data, which are covered at a very high resolution, like 100 meters for river and coastal flood. And they measure also not only the damages of the infrastructure, house, and so on, but also the population at risk. Of course, when you got this very nice data, you would like to know which house or farm or whatever is insured, but unfortunately, we don't know. So we have this very nice data, and yeah, okay, we rely on the population at risk. So we need to come up with an economic measure, so we know how many population is at risk, and we come up with this measure, which is called we refer at the expected annual human losses over 1 year, and the corresponding exposure of people under different term periods. Of course, we have several of them because the Risk Data Hub is providing a very detailed set of numbers for these amounts. But of course, we have to come up with an economic measure, economic monetary losses for flood, river flood, and coastal flood. So to do that, we consider the GDP at country level and the share of population which is affected over the total population, and we multiply this by a vulnerability index still provided by the Risk Data Hub. So this very, I would say, might be also a trivial calculation, but unfortunately, we cannot do better with the data that we have. We come up with this measure of the expected economic losses in million euro at the member state level for all the European countries. But I mean, we explain a little bit better in the paper that stuff. It turns out that this measure that we are using is, I would say, in the same ballpark than the one that are used by, considered and calculated by the EIOPA with confidential data. So after this kind of, let's say, estimation that we have, we're kind of confident that we are having somehow the numbers that are in line with the one of the EIOPA. So, of course, we have to rely on the EIOPA, and they provide data on the insurance penetration rate for, let's say, the flood. They have different perils like river flood and coastal flood. We decide to aggregate all of them. And interestingly, the values of the insurance penetration rate, how much are the, let's say, the property that are insured over the total amount of property, is very low for Netherlands, and very high for other countries like Sweden, Czech Republic, Finland, and Belgium, for instance, and so on. So this Netherlands super low, and the other are well above the 80%, as you can see from the chart there. So the case of Netherlands is kind of peculiar because if you look at the statistics of DNB, which is the central bank there, they said that basically 60% of Netherlands is at the risk of flood. But there is actually no market for the insurance for flood risk and river and coastal flood risk because the risk is too high, and because, of course, there is the government intervention. So at some point, if the disaster has been declared a natural disaster, a natural catastrophe, the government is repaying all the properties and so on. So actually, the premium, either the premium is too high, so no one is going to have the premium, or let's say the incentive of the people to buy an insurance on that are pretty low because of the government. But despite that, okay, there is still room for improvement. Of course, there has been a lot of attempts to create an insurance market there, of course, to decrease the amount of losses for the government, but so far has not been very successful. So EIOPA also provided other data, total technical provision and gross premium written for the non-life insurance. Of course, the damages usually refers to the house, but of course, when you are discussing about premium for non-life insurance, the part covered is bundled into the fire or accident or other kind of things. So the river, coastal flood are just one of the risks that are considered in the insurance. So of course, this is a proxy, but unfortunately, it's very difficult to disentangle between the overall amount covered and only the part related to the flood risk. And in order to come up with an estimation, we use, of course, the data that I just mentioned. So the data from the expected losses has been calculated from the risk data hub and the EIOPA penetration rate. This is going to give you a very first measure on what can be the expected, an estimate of the expected pure insurance premium and the gross premium. Basically, the pure premium and the premium without the insurance margin. So, having said that, we consider the increase up to 50% and 75%. We made an assumption that is €1 additional of expected losses is translating into a €1 of a new premium, which is kind of reasonable, I would say. Unfortunately, there are several caveats on this. The first one is the insurance margin, which of course might be larger if we are talking about insuring a part that is not yet insured. So of course the risk there might be higher with respect to the actual part that are insured. So it might be that the insurance companies are requiring a higher premium for this insurance. So in our framework, we assume, let's say, a constant margin, but it might be that is not the case. And of course, there might be some potential non-linearities between the increase in expected losses, and the premium. So for the margins, we use an average estimation from the EIOPA data, which is very stable actually across the year. So this 47.5% is stable across member states and across the last, let's say, 10 years. For the second, we come up with another, let's say, econometric tool, which is the co-integration, and we assume that, which I think we believe is not, let's say, a super strong assumption, that the technical provision and premiums basically move together. So this is an example on the plot on the top right for Croatia, but we did some, let's say, co-integration test at the country level for all the other countries to see whether this assumption of co-integration hold. So since the technical provision and the premiums, so just to make it clear, technical provision are, let's say, the money that the insurance has to put aside to cover the expected losses, while the premiums are the money that are collecting from the insurers, from the insured people. So these two things move together. We immediately saw this from data, and they are non-stationary. So we kind of exploit these properties, and we use a vector error collection model, which is a special case of a RP model with some lag. And we put on top of this, and we try, I mean, this is the actual tool that we use in order to model the future dynamic. We are interested in the, let's say, in the dynamic and how the model behave and so on, the system behave and so on, but we are much more interested in the shock. So in the impulse response function. So since we want to keep the long-term dynamic fixed, because we know that the two things move together, we impose some restrictions, which is that the long-run coefficient for the premiums is equal to 1, and the one for the technical provision is equal to -1. Of course, this does not prevent the short-term coefficient of the vector error collection model to move, and we are actually interested in the short-term dynamic rather than the long-term. Of course, we calculate the orthogonalized impulse response function, and this is something, let's say, an additional piece of our, let's say, overall model in order to have an estimation on what might be the response of the premium to a shock on the technical provision. There is another assumption here is that, of course, the expected losses of the insurance company at the beginning of the contract represent a consistent part of the technical provision. So we assume, at least for the sake of the model, that technical provision and expected losses are somehow very strictly related. In reality, this is not true because the technical provision are having a different pattern, a different behavior with respect to the expected losses. But okay, this is for a new contract, the two things are somehow can be related. So we use this additional piece of, let's say, of our equation, and we come up with these two expected gross premium, which is the one that need to be written in order to harmonize the penetration rate at 50%, which is the EGP 50 for member state I, or 75%. So basically, we have the difference of the penetration rate between, let's say, the actual amount and the 50%, times the expected economic losses that are the one that are coming from the risk data hub and the estimation, times 1 plus the impulse response function, which is this additional shock that we put, plus the margin. So all these pieces together in our framework are providing somehow an estimation of what might be the premium, the additional premium to write in order to reach the 50% or the 75% penetration rate. On top of this, still related to the, let's say, the increase in the insurance penetration, we also use, let's say, a very stylized model, which is inspired the Vasicek 2002 model, in order to model not to model a single insurance undertaking, but to model all insurance companies at the individual country level, or at the, let's say, at the aggregate EU level. So we use this portfolio model of credit risk, which we adapt, of course, with some parameters that are more connected to the insurance sector. And we use this model, well, of course, in the event of a default, which occur when the asset value falls below a threshold. So this maximum loss that we define as L cannot be exceeded in 1 year with a probability level alpha, which is 99.5% in our case, and is given by this formula, which is, I mean, I think is quite a known one. Where, of course, the EID is exposure default, LGD is loss given default, N is the normal distribution, rho is the correlation between the value of the different position of the insurance, of the insurers, and the PD is the average probability of default of the insurers. So, of course, the expected exposure default of the technical provision, which is our best estimate of liability, and the risk margin and the solvency capital requirements, as assumed as the total amount of the funds, which is required to ensure that the company will be able to meet the obligation, as a probability, as I told you, of 99.5%. And the exposure default is given by the solvency capital requirement plus the technical provision. So we consider two scenarios in this case: a baseline scenario when we compare the actual situation versus an increase in the penetration rate of 75%, which of course is let's say a standard one. And since we have also data on different projection of the potential losses in the future from the risk data hub, we use a very rare event, which is one every 200 years. I was kind of shocked to see Luca's one every 1,000 years. I mean, we rely on a different horizon. For us, it was still pretty large one. But this is basically the 0.5%, which is a well-known parameter for the insurance companies. And we compare these two results with the 75% penetration rate. So, of course, the final losses that we in this case, we put on the public finance are computed as the sum of the part this is not insured, and the leftover from the insurance sector, of course, from of course, the default of the insurance company given by the model that we just described. So some results. This is basically, okay, on top, there is this box plot that shows you how much we should need to increase. I mean, this is at the member state level. We have, of course, not all 27 EU member states, but only the one that are having, let's say, a protection, an insurance penetration lower than the threshold that we set. And we see that to have an harmonized penetration, we should have at least 10.8 billion more of insurance premiums, and that 75% are 19.7 billions. And if we say that the estimated premium that the EIOPA put for flood events is roughly 10.06 billions, which is, as I said, a proxy because the non-life insurance is bundling all the risks. We estimate in our case, with our data, I was saying at the beginning that we were pretty much in the same ballpark. We estimate this premium, actual premium, as a 12.6 billions, and the EIOPA estimated 10 billions. Okay, 2 billions, but still we are the same order of magnitude. So in other words, for flood events, we should increase by more than 50% the premium to reach at least a 50% penetration, assuming that, of course, all risks are insurable. And of course, we need to double the premium written to reach a 75 penetration rate. Okay, these are the results on the public economic losses from the Vasicek model, the stylized Vasicek model. As you can see from the box plot, in the baseline case and the worst case scenario, as you can see in the reduction is substantial. I'm referring to the bottom part of the plot. If you see the baseline scenario, almost as a share of GDP, the average losses are somehow half. As you can see, the box plot is much more concentrated on the bottom, and in the worst case scenario, the reduction is much more reduced. So I would say I can close here. I was just, let's say, considering some of I'll just discuss a little bit of the caveat of this work, which is, in our view, is a very conservative estimation, because of course, as the risk increase, the price of reinsurance increase, which we are not explicitly modeling here. And there is also some other caveats that the flood impact, economic impact, is rather difficult to estimate. We're not considering adaptation and mitigation measure. And as I was saying, the reinsurance is not considered in our framework, which might increase substantially the premiums, because it seems, at least looking at the most recent market data, that there is not much appetite for the investor for, let's say, this reinsurance product. So it might be that the insurance company is not able to sell the risk to the reinsurances. And yeah, so I think it's over. Let me do a small advertise of my previous job, which is, let's say, the Joint Research Center, which is a very nice place, which is working for the European Commission. So basically, we are the science arm. I was the science arm of the European Commission. We are in several places. The biggest one is in Ispra, and there are also in Belgium, in Germany, and in the Netherlands, and in Petten. And yeah, and these are the. Sorry, I did a little bit of advertise.
Quite a sobering assessment. I wonder how, politically, how that would fare if you increase the insurance premium by 50%. How would that go?
Cannot comment on that. Sorry.
Anyway, let me now introduce the discussant for the three papers, who, as you know, will be talking to us, beaming from Washington, D.C. So let me let Peter Windsor from the IMF discuss the three papers.
Hello. I hope you can hear me well and see me, and hopefully in a moment you'll see my slides as well. So let's see if these come up okay. Okay, so thank you for the opportunity to be the discussant on this panel. I think affordability of insurance premiums and the increasing insurance protection gap in the face of climate risk is a topic that's becoming much more prominent, and it has consequences beyond the insurance sector and potentially spillover effects for other parts of the financial sector and public sector finances as these papers actually generate. So it's great to see attention to these issues. I think the papers address the issue from three very different perspectives. So you've got the Jung et al. Paper that considers the impact of climate risk on the insurers themselves through the market-based climate risk beta. The Zanin et al. Paper that conducts a stress test on the mortgage loan portfolio and finds that insurance is a material mitigant of credit risk. And then we've got the Bellia et al. Paper that looks at the consequences of the insurance protection gap and projects that into the public finances in the EU. So I think these are complementary perspectives and shows that the insurance protection gap is a significant issue that warrants attention by a broad set of policymakers. So getting into the papers themselves, the Jung et al. Paper, I think it assesses the climate risk exposure of the property and casualty insurers and the life insurance companies, looking at the market impacts through the climate beta metric. I think some of the key insights that I found is the notable increase in transition climate beta in 2019-2020 with the collapse of the fossil fuel prices, and also the increasing climate beta for the P&C insurers. But one thing that really quite stood out to me was that there was no notable secular trend in physical climate beta for the P&C insurers. And another key finding for me was that the small P&C insurers tended to have the higher physical climate betas than large P&C insurers. So that led me to a couple of questions, particularly around the results on the P&C insurers, and that is, to what extent are the markets actually pricing in climate risk? Is there an inherent underestimating bias? And probably a question for the future that can't really be answered by the researchers is, will the improved climate disclosures, the process that we're going through at the moment, potentially change this? And another question, we do see a lot of insurance research done based on US data because it's the most available and most granular. But I do ask in this situation whether this is something that could be extended to other regions, for example, Europe, or whether there's restrictions on only looking at US data because of its availability. And then moving on to the Zanin et al. Paper, the climate stress testing for mortgage default probability. I think what we see is a series of outcomes that are quite intuitive about the coastal areas being more exposed to flooding risk, mortgage default being more likely in those areas that are highly exposed to flood risk. I was very interested in seeing the numbers put on what's the difference between a 1 in 500 return period compared to 1 in 200 return period, and that actually tripling the probability of default, and a further doubling for 1 in 1,000. So I think clearly for the topic of this panel, the findings on insurance coverage playing a pivotal role in mitigating credit risk is something that's particularly insightful from this paper. So that brings me on to questions and further considerations. So one of the things that sort of jumped to mind is that, I note the chair's comments on public insurance. So in the US, flood insurance is dominated by the National Flood Insurance Program, and there is a mandatory requirement for federally backed lenders to have flood insurance in place for high-risk properties. But notably, there's a substantially lower return period for identifying those high-risk properties than in this study. So it would be quite interesting to look at an overlay of the FEMA flood maps on impacted areas generated by the storm model, because it's likely that many of the properties that are impacted by, say, a 1 in 500 or 1 in 1,000 event would not have flood insurance, just simply by the way that the high-risk properties are actually identified. I think the other thing that sort of jumped to mind was, and based on some of the policy considerations, is that this is focusing on the impact of major disasters, but we're also seeing increasing insurance premiums in many of these areas, and what might be the impact on borrower default risk from that increasing requirement for household budgets. And maybe looking at some second order effects, so where where insurance is not prevalent in some communities, what is the impact on employment and the local economies, and how might that actually transfer into borrower default risk as well? So just going through some of the policy discussion, I've already covered the first point there, but one of the points made by the researchers is that banks, insurance companies and policymakers should incentivise proactive adaptation measures, and it's really more of a rhetorical question rather than one for the researchers, is, how could this be done? Have there been successful examples? And I think also the role of insurance premiums in communicating risk is an important thing. We see many examples around the world where governments and regulators are seeking to protect households from the increasing insurance premiums in the face of climate risk. So I think some of those issues need to be considered. I also note the researchers set out the issues about the barriers to implementing adaptation measures that might deal with the costs of insurance premiums, and also the concern about risk perception and tolerance to extreme weather events, and again sort of brings to mind that role of insurance premiums in communicating risk. I thought it was very interesting that researchers noted the potential issue of moral hazard induced by public insurance, maybe leading to individuals not taking necessary actions to reduce the costs associated with natural disasters. Then moving on to the Bellia et al. Paper, as just explained, this paper looks at the impact of the insurance sector providing higher consistent coverage in EU member states, and it puts a number on expected economic losses, noting that a significant component of that in Europe is related to the Netherlands. EIOPA's work indicates that 13 of the 27 member states already have flood protection levels above 50%, and 11 of those at or above 75%. So, this paper very much focuses on those that don't have those protection levels. I thought it was insightful to note that those higher insurance penetration levels are actually linked to places that might have public-private partnerships that provide reinsurance for natural disasters, and where there is the existence of mandatory insurance schemes. I think the Netherlands is notable also in having high flood risk and low flood insurance penetration levels. So the significant increase in premiums is notable to reach that minimum penetration level across the EU. I think some of the issues noted were things like the model had been calibrated on observed small marginal increases in insurance coverage, with the insurance margin increases that might not be adequate for larger increases in coverage. So that leads to the conclusion that, you know, these results are basically a lower bound. I also noted that the increases vary widely between member states, and that seemed to be largely down to the starting penetration levels. So I think the ultimate conclusion is for the public sector risk, and the fact that the increased insurance coverage would lead to a reduction in public sector costs for most member states. But I did notice that the reduction in public losses at the 75% level was actually less than the additional amount of premium required to achieve that level. And there were a number of caveats noted in the paper, which we've heard some of those, but they sort of lead on to my questions and further considerations. Obviously, reinsurance is a key to the non-life market. So that's something probably for a future paper to try and take into account the role of reinsurance. Also, the effect of increasing concentration risk caused by the increasing penetration rate, something the authors acknowledged was difficult to model, but that's obviously an area that of potential future research as well. And the increasing risks are likely to lead to non-linear increases in capital to support the increased risk, which is another point acknowledged by the authors. And also the difficulty in modelling mitigation and adaptation measures. That's something that's an additional item to consider. I think overall the conclusions are measuring the insurance protection gap is highly uncertain, can be diverse by country. I think that the finding that smaller insurers can be more exposed probably is linked to their more regional exposures. And there's the need for vigilance about financial stability risks and from potential spillover risks to other financial sectors. Role of reinsurance is important and could be subject to further research. I think there's a theme across the papers about the difficulty of considering mitigation and adaptation measures. So it's likely that addressing protection gaps will require coordinated policy efforts to incentivise take-up of insurance, to implement mitigation and adaptation measures to reduce risk and increase affordability, and to consider the role of public sector in addressing uninsurable tail risks. I'll stop there.
Pete. Thank you very much, Peter. These were very detailed and thorough comments. Maybe I will have first the authors react or comment on Peter's discussion. Hyeyoon, you want to start?
Sure. Thank you so much, Peter, for your thoughtful comments. On your first question on the market pricing of climate risk, we've seen so many papers, including great papers of Patrick, on the finding that the markets are pricing in the climate risk, but of course, we wouldn't know whether they are underestimated or overestimated. So using market-based approach is a benefit, but also can be a cause because we can only measure up to what market is pricing. And I would love to see future work investigating on that. And your second question on other regions, estimating would be doable on European insurance companies. And I think it would be especially interesting to look into reinsurance companies in Europe because they are mostly in Europe rather than in the US. So we are working on it. But unfortunately, validation exercise won't be possible because the granular data is not available in Europe as far as I understand. So thank you again for your comments and appreciate it. Thanks.
Let me turn to Luca now.
Thanks, Peter, for your points. So our climate stress testing framework includes a proxy of the insurance. In particular, we consider the ratio between the number of insurance and the number of property in each three-digit zip code. So it is a proxy variable that we include in the model. Obviously, the best solution should be included the information on the insurance and then match this information with information mortgage performance, the best solution. So I think that working with public data, it is very, very challenging to have this information, match this information. But I think also with Banca, it is a challenge today, merge information on insurance and information on loan mortgage. So I think that we must work on this to improve the analysis of insurance and mortgage performance in this direction. So I agree with all points suggested by Peter, and in our standard paper, we have discussed this point by looking at the literature in this regard. And in particular, looking at some studies that suggest the proactive adaptation measures such as fiscal policy to incentivize on workers to improve their protection on the home, the location, for banks to incentivize specific product in terms of specific instrument to incentivize the investment in adaptation measure, such as protection from flood or specific protection from wind speed derived by hurricanes. So we address this point in a specific section of our paper in more extensive way.
Okay, thank you, Peter, for your very thoughtful discussion. Yeah, I'm going to touch basically a couple of points. So, as you mentioned, I mentioned also in my presentation, the insurance part is kind of difficult to model because we are somehow assuming a huge increase in the coverage, in the gross premium written. And our tools that we have at disposal are kind of more suitable for a small marginal increase. So, of course, we will need to have a more tailored analysis and to add on top of this another model or something to model much better the reinsurance part, which is, I would say, tricky. Adaptation and mitigation. There are some colleagues, former colleagues at the Jersey, that are working more on that part here, that are trying to estimate and somehow put a price on the mitigation and adaptation measures. And there are also some other work streams that are somehow trying to link the adaptation mitigation to the insurance premiums that you pay. Basically, the tools is like when you have a car insurance and you allow the insurance company to install in your car the black box that they are monitoring you, you have a discount on the insurance company, on the insurance premium. Basically, they are trying to come up with some solution on that regard. So if you are somehow putting some adaptation and mitigation measure in your house, on your property that reduce the final risk, you're going to have a huge discount on the insurance. But this is still on its infancy, I would say. On top of this, I'll give you a very nice anecdotal evidence that I got this morning in my flight coming from here. There was this German woman, which she told me that basically, because there has been a huge flood the last week in the south of Germany, in the Bavaria region, and she told me, I mean, I didn't check myself, she told me that basically the insurance companies were sending SMS text messages, the owners of the car, that they have to move their car from the at-risk part of the Germany, because otherwise the insurance was not supposed to cover the losses. So this sounds to me a pretty weird stuff to do, but I mean, this is, she told me that, I cannot confirm. So, but thank you, Peter, for your very interesting discussion.
Okay, well, our time is almost up, but I would like to open things for Q&A now. So can I collect maybe 3 or 4 questions, and then we'll take
Hi, Carolina Bassa from Oxford. I have a question to hear. So it's regarding the comment that Patrick made that actually government is often acting as the insurer of like last resort. So there are many places in the US, for example, Florida, from which private insurers stepped out, and it's the government that's stepping in. So in a sense, the private insurers are not exposed to those extremely physically exposed regions. But it's also that if the disaster is declared like the federally declared disaster, it's also the government stepping in. So it seems that the insurers are not actually facing the tail of the distribution, which for your research would translate into the fact that the climate factor is underestimated, right? And that adds even to this underestimation that Peter mentioned, that in a sense it's the market expectation or like market perception of the physical risks, that and the market might not be pricing enough. We know that it's pricing some, but it might not be pricing all of it due to, I don't know, like tragedy of the horizon. So it seems that we have possible underestimation from the fact that it's the market's expectation, and it's also possible underestimation from the fact that insurance are actually not facing the tail of the risk that is actually there. So I was wondering, how would you comment on that, and whether you would be willing to apply this climate risk factor that you develop for other companies and insurers, considering this possible underestimation?
Yeah, thank you. I'm fully with you.
Let's see if there are any other questions.
Sorry.
First. Yeah, let's collect a few questions and then.
Sounds good.
2 questions. A general one concerning the fact that the public insurance provocation maybe, but it could be optimal in certain cases. Think about the Netherlands or other high-risk countries where you have insurance programs. The government, the state could be the insurer last resort that is most adequate to deal with such a tail risk. So that's just a question mark. I understand that the idea behind Mario's research is to shelter the government budget from these things, but in the end, it might be the case that in certain cases, with the vanishing market, for instance, which is likely to be a scenario going forward, that could be in the end the least bad of all alternatives. The other thing is to quote a paper by the Bank of Italy that we published recently based on a survey, which shows a result that we are still trying to analyze, further understand, which basically says that in 2 out of 3 cases, the entrepreneur going to the bank to discuss a loan fails to give value to insurance coverage that he or she has. And this fact is puzzling. It may reflect lack of proactivity by the entrepreneur who maybe forgets to mention this. It may reflect the fact that the bank says, well, this is nice to have, but in the end, the coverage is too diverse. There are zillions of different types of coverage with all possible caveats and provisions. But it made me think about what you mentioned for insurance coverage and mortgages in the hurricane area. You mentioned that this may be something useful for the mortgage industry, which seemed to imply that this is not used really in that industry. And so I just wanted to throw this to you. Thank you.
Great. Thank you for your comment. I was going to say that I'm fully with you, and that's partly why we are seeing that these private insurers, physical risk, C risk is actually negative, which means that they don't seem to be exposed, and it's partly because private insurance companies are exiting as the risk is becoming very high. However, on the underestimation or overestimation of market pricing, based on my read of literature, there have been papers on both sides, so I look forward to reading more on that. Thank you.
Yeah, I mean, coming to the question of the Netherlands, I mean, it's I've been researching a bit, also discussing with some people there, and they basically, some answer that I got is like when they build up the dikes, they said that the dikes is built to be to resist to a flood event that happens one every 200 years, which is basically the same tail events that we are discussing in our paper. So having said that, it seems that there is not much, I would say, moral hazard from the population. And say the population is not willing because to insure the house because they are kind of trusting the government, and also the government is stepping in that case. So there is like, as long as we are not breaking this circle, the whole thing is not going to work. So, I mean, I'm not saying we need that a dike in Netherlands is going to need to fall to see what's going on, but yeah. Okay, great. Good to know. Yeah, please. Please, I'm Italian. I'm actually from Venice, so here is like home for me. So yeah.
So the government does actually condition it. So they say they have about classification of 6 different categories of what they do when there's flooding. So there's some areas they say, well, just prepare to give it back to the sea, literally give it back to the sea. So if you get flooded there, your own risk, you're on your own. Another stuff that clearly is not the case. And then a second complication is that there are 6 dike rings, and then the problem they cascade, but on the whole, it's really not the whole GDP that's at risk. It's usually just contained with one dike ring. Then again, there are quite clear rules on which they do compensate and which they do not compensate.
Can I add another angle to this? It's a very interesting discussion. This is based on work of a PhD student in Amsterdam, and she makes the point, which I think all of us, have heard already here, which is that there's just underinvestment in adaptation and underinsurance, partly because most households don't have the financial means. But then the implication is, well, shouldn't you go for where the financial means are? And if you follow that logic, what comes out of her analysis is that we should move from a model of house ownership to a model of rental with concentrated ownership in a few large funds who have the incentives, who have the financial means to do adaptation and mitigation. So that's a whole other angle. So almost a societal change in response to this. I guess our time is up. Let me thank everyone for being still here and alive and awake. It's been a long day. And thank you for the speakers.